Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did. Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How are you doing this morning? Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And you don't forget it.
Welcome to another edition of Talk Money. Thank you for taking the time to tune in. We are here to help you make the important financial decisions. Our ultimate goal is to improve your money IQ. And if you're joining us for the first time, my name is Jeffrey Shank, chartered financial consultant and owner of Andover Advisory Group, a registered investment advisor. If you have questions, don't be shy. Let us know. We'll be glad to answer it here on the show, or we can respond directly to you. You simply have to just put your questions right on the Facebook page or send me an email. It's jeff@talkmoneyradio.com. Or if you want to reach me after the show, call the toll-free number at the bottom of the screen. Send it, and we can always set up an initial meeting if you want to find out a little bit more about our services and what we might be able to do for you. And we have some good stuff lined up today. Look,
excellent, as usual.
We're going to talk a little bit about a problem, a growing problem, and that is debt among an older population.
They finally figured it out, huh? Just
finally figured it out.
Not going to be around that long. Just run up some debt.
Well, it apparently the amount of debt among people who are near or at or in retirement has been growing at a potentially alarming rate. Yeah,
I can imagine.
I want to share with our audience some of the statistics and talk a little bit about it, and maybe some things to think about if you are getting close to retirement. And also, we're going to talk about naming beneficiaries on your life insurance. The 5 biggest mistakes to avoid when naming beneficiaries for your life insurance. And
can I guess at number 1?
Go ahead.
Leaving your ex-wife as the beneficiary policy.
That's funny. It's funny. You got a smile on your face when you thought about that one.
Yeah.
And that's not one.
That's not one?
That is not one.
Wow. Okay.
But probably should be number 6.
Yeah. There you go.
Or maybe it should be the first one.
Yeah.
And we have this week's Talk Money tip as well.
Excellent.
But well, let's just start with this growing trend among older Americans. A recent study by the Center for Retirement Research, CRR, at Boston College, and the Employee Benefit Research Institute, EBRI, reveal what they're calling an alarming trend. The percentage of older Americans with debt is at its highest level in almost 30 years. Mm-hmm. And the amount and types of debt are on the rise. So in the 20-year period from 1998 to 2019, debt increased steadily for families with household heads age 55 and older. So the head of a household, 55 and older.
Yep.
In recent years, the increase has largely been driven by families with household heads above age 75 and rose from 38.5% to 51.4% in that time period over the last 10 years or so.
51.4% have debt, significant debt.
Have debt.
Yeah.
Yes. I don't know if they termed it significant debt.
Yeah.
But have debt.
Yeah.
generally speaking, have debt. And so the percentage of those households age 75 and older, right?
Mhm.
It grew from 38.5% to 51. So 1 out of every 2 households
Yeah.
headed by someone 75 or older grew from 1/3 to 1/2 in that 10-year time period. And that's the highest level since 1992. By contrast,
I'd have taken the
interestingly
over
enough-
on 51%.
See that again?
I'd have taken the over on 51%. If you asked me,
So you think it would have been
beforehand.
higher?
Yeah.
Yeah. So 75 though. Low.
Yeah.
75?
Yeah.
Really?
But everyone's got a credit card, right?
Well, no. So if you use your credit card, you pay it off. That's not considered debt. So you're using it as a tool to pay your to pay for your day-to-day expenses. If you pay that off at the end of the month,
Yeah. What
then
percentage
you're
of
not
people?
you're not carrying that debt.
What percentage of people does?
Well, I don't know.
Does that?
I don't. Well, a lot of my clients do, and
Yeah. Oh, sure.
especially those
Advise
who are
people
retired.
would, yes.
Yeah, advise people, right? Yeah,
Yeah.
exactly. So let's just take a closer look at this. I think I have a graphic. Should be up there.
Yep.
I can't see it here because this window is in my way, but there it is right now. Okay. So let's just take a look at it, right?
Yep.
So the percentage of people 75 and older with debt by type. That's what this is. 22%, to your point, Lou, is credit card debt.
Right.
24% is housing debt. So we're talking about a mortgage.
Right.
Whether it be a first mortgage or an equity line. In a lot of cases, it's a combination of both.
Mhm.
And 38.5% have overall debt. Yeah, this was in 2010.
Right.
Right. And then in 2016, that rose to 49.8% overall. And then the number that I mentioned earlier, 51.4%. Interestingly enough, the credit card debt grew the most in that time frame, from 22% in 2010.
Yeah.
And again, these are people age 75 or older, from 22% to 26%. And that is a potential negative when you're in retirement and relying on maybe a fixed pension or a fixed income, Social Security,
Right.
and perhaps some money that you've saved up, because you have this obligation to pay this that has to get paid first. Right. So let's just look at some of the potential negative consequences. First of all, mortgages comprise the largest proportion of debt carried by older Americans, representing 80% of the total burden. According to the EBRI, the median housing debt held by those age 75 or older jumped from $61,000 in 2010 to $82,000 in 2019. The CR study reported that baby boomers tend to have a bigger debt loads than older generations. And I should mention, because I skipped over it, that by contrast, younger individuals during that same time period,
Mhm.
their overall debt load increased slightly or stayed the same.
Oh, okay.
So apparently the baby boomers generation
Yep.
have embraced or taken advantage of debt for some reason at a greater rate than younger individuals. I don't know what it says about younger individuals or the baby boom generation, but maybe it suggests that younger folks are not willing to borrow in order to finance their lifestyle.
Yeah. Well, they've learned from the baby boomer parents' mistakes. For one thing.
Have they?
Maybe.
You mean as a
But-
group, or directly from their parents?
But baby boomers went from that young period of financial instability to careers, jobs, put some money together, created some debt, and then probably get into that lifestyle and that habit. Young people haven't done that yet. I know I wouldn't have been I wasn't anxious to get into a credit card and accumulate some debt when I was young. You didn't want to do that.
You were reluctant to do so.
Yeah.
Yeah, as was I. But once you
because you're working at the Sea Catch in Hampton Beach. You don't know if you can pay that off. Plus, you had less when you're young. You have less pressure on enlarging your debt. You don't have your monthly cash flow is a little different. You don't have big bills. You don't have mortgages. You don't have...
Yeah. So I'm not sure what the definition of that younger cohort was.
Yeah.
It's very possible that they're talking about teenagers or 20-somethings, but it's very possible they're talking about 30 and 40-somethings.
Yeah.
So there seems to be a trend.
Yep.
And that trend for younger people is a trend away from accumulating debt, whereas for the baby boom generation and those 75 or older, apparently it has been on the increase for whatever reason.
Yeah,
I mean it's possible that they were forced into that situation. Don't forget the crash in 2008. A lot of equity was lost. A lot of houses were lost.
Yeah,
and so that could have put them in a bad situation where they had to borrow money in order where they would have not ordinarily considered doing so. Right.
I'm surprised the mortgage debt hasn't increased more than it has, because you would think that more people 75 years or older are still in their houses than might have been 20 years ago.
Mm-hmm.
And reverse mortgages, I thought, might play a role in this. And
so actually, you know what? I didn't have a chance to look into that.
Yeah.
And I wonder to what degree reverse mortgages are a factor.
Yeah.
Here, because it is a debt. You don't have to make payments on it, but it is a debt that has to be paid at some point in time. Mm-hmm. So it's very possible that the increase in the mortgage balances here, the average mortgage balances, and the increase in overall housing debt, could be attributable to the reverse mortgage, because it's becoming much more common and much more cost effective for people to do a reverse mortgage. Mm-hmm. So if you take a look at the negative consequences, essentially, of having mortgage debt, is that, first of all, changes in interest rates, home prices, tax changes related to mortgages may have a significant impact on a individual's financial situation. Credit card debt, which is the largest form of non-housing debt among older Americans. The incidence of those age 75 and older reporting credit card debt reached 28%. Again, its highest level ever. And the median amount owed rose from $2,100 in 2010 to $2,700 in 2019. Doesn't sound like a big increase, but it is it is an increase, right?
Where's the impact of student debt in this?
That's a great question.
We've been told student debt is bigger than credit card debt,
and that would be for that younger cohort. But apparently, for people aged 55 or older, it's not as is not as significant a factor. So this is not brought on by student loans. Let's put it that way. Yeah. Medical debt is also a problem, right? The CRR study showed that 21% of baby boomers reported having medical debt with a median balance of $1,200. Among those coping with a chronic illness, 1 in 6 said they carry debt due to the high cost of prescription medications.
Yeah.
Finally, and perhaps most surprisingly, student loan obligations are the fastest growing kind of debt held by older adults.
Really?
Yeah. Yeah. And so contrary to what I was alluding to earlier, it does appear that older folks are generally not borrowing to pursue their own academic or professional interests, but instead helping children and grandchildren to pay for college. And so that is included in that overall balance.
Yeah.
So how might it affect your retirement? Well, both the CRR and EBRI studies warn that increasing debt levels may be unsustainable for current and future retirees because of stress. Mm-hmm. Right? If you owe money, it can be stressful.
Sure.
Which could impact your health, and could increase the amount of medical debt that you have to take on. So sort of a spiral, right? Another potential impact is that individuals may find themselves postponing retirement. simply to stay current on their debt payments. And another risk that both workers and retirees may be forced to tap their retirement savings accounts earlier than they anticipated in order to pay off that debt or to keep
Right.
it in order to keep it current. And another thing to consider, and I think that this is probably the biggest risk that I think everybody faces today when it comes to debt, but could impact baby boomers and retirees at a much greater or have a bigger impact on those people, is the fact that interest rates have been way below
Right.
the mean for the last 20 years or so. And although it's been held in check for a period of time, eventually we will regress
Yes.
back to the mean.
Mm-hmm.
It's inevitable, right?
Right.
And so what's going to happen if interest rates do rise? And usually what happens when we regress to the mean, we actually overshoot. And we could see interest rates at a very high level in the next several years.
Right.
And if you have credit card debt, for example, if you have any sort of debt that the interest rate is variable, what happens is your debt service rises
Right.
as a result. And again, if you're retired, you're on a fixed income, that could be devastating.
Right.
Absolutely devastating.
Mhm.
So I think it would be smart for anybody who is carrying debt at this point, if you are at retirement, near retirement, or even in, if you've been retired for several years and you're carrying some debt, might be a good idea to start thinking about, especially if those interest rates, if the interest rate is fixed and it's locked in at 2%.
Yeah.
That's one thing. But if
Avoid variable interest rates like the plague.
or if you actually already have
Yeah.
like an equity line, for example, or a credit card debt, it's very possible that those interest rates could get out of control.
Yeah.
And so would your debt obligation as a result, your monthly obligation, which could have a devastating impact on your overall retirement. So the thing to do under those circumstances really is to sit down, review your cash flows, take a look at where the if you have any debt, where it is, how it's secured, what are the interest rates you're paying now,
Right.
what's the potential for interest rate increases. Given where interest rates are right now, let's say you do own a home, let's say you have some credit card debt,
Mhm.
or maybe even an equity line with a variable interest rate, might be a good idea to consider refinancing
Yeah.
all of that debt, consolidating it into a mortgage using the house as collateral so that you can get the lowest rate possible,
Mhm.
fixing your obligation over a period of time. And then there is the other option, especially if you're the right age, and that is potentially anyway, a reverse mortgage. Reverse mortgage is something to that you might want to consider. They have received a bad press
Yeah.
over the years. They are highly regulated. They're not easy to get. You have to take classes in order to obtain one.
Really?
Yes, the government requires that.
No orientation?
Yes.
Yeah.
Yeah. You get it from a certified, totally independent organization delivers the orientation.
Wow.
Yeah. So
I wasn't aware of that.
yeah. So the reverse mortgage agent can't be the one that delivers the class to you. It has to be
That's a good idea.
it has to be an independent third party certified.
Yep.
Certified to do that kind of work, so that there's no misunderstanding about how they work. Because bottom line is you don't have to make payments. You can pay it off if you want, but you don't have to, and you don't make interest payments, and the principal balance grows if you're not making payments against that mortgage, and eventually has to get paid off. And that would be when you sell the house or you die.
Mhm.
Then that mortgage has to get paid off, and so you have to be very careful
Yeah.
about the use of that sort of a vehicle. But it's a tool.
Yeah.
As we say here on Talk Money, it's like fire, right?
Yep.
You can use
You
it
can warm
to
your feet or burn your house down.
right.
Warm your food or burn your house down.
Yeah. So bottom line is you have to think about your debt load today if you're getting ready to retire, and what does it look like in the future, and maybe even build in some variables like what happens if interest rates go to X in the future. Will that have a negative effect?
Am I right that people might be a little confident in the fact that feds have said they don't want to raise interest rates?
Yeah, I think overconfident.
Overconfident because private interest rates aren't necessarily locked into that, right? Certainly credit card rates aren't. Credit card companies can do what they want, basically.
Yes, but generally speaking, those rates are dependent on the current interest rate environment.
Mm-hmm.
So they'll take a look at prime and they'll add something to it.
Right.
But that addition, that premium that you pay, a lot of times depends on your credit score.
Right.
So they're looking at current interest rates, but they're also looking at the individual when we're talking about credit cards.
Yeah.
In the case of a variable rate mortgage, they can't change the interest rate arbitrarily. So they can't look at your credit score from time to time and say, "Oh, sorry, we're going to raise the interest rate." So it is really just based on the prevailing interest rates. And if it is a variable rate note, usually what they're going to do is they're going to use some sort of index, whether it's prime rate or LIBOR or something like that, and they're going to add or subtract a certain number of interest rate points from that or to that particular rate. So you can do some estimates. If it's an equity line, you can do some estimates. If prime goes to X, here's what my interest rate is going to be, and here's what my payment's going to be as a result, and kind of do some modeling and see how it would affect your cash flow and whether or not you'd be able to handle it. If rates go up, you can't. Then it might make sense to start paying down some of that debt. Yeah, one way or another.
But my point was that people shouldn't be overconfident in the fact that the Feds aren't going to raise interest rates, because it doesn't necessarily mean your interest rates aren't going up, especially if you need to create new debt.
That is true, but the driving force right now for interest rates in just about every product that you any sort of loan that you take out is where the Fed is with regard to short-term rates and their bond buying program. Mm-hmm. And so actually last week, one of the Fed presidents came out and started saying some things that seemed contrary to what the Federal Reserve Chairman was saying, and so it's kind of spooked the markets, and that's why apparently that's what they're saying anyway. That was what sparked a big sell-off at the end of the week last week. So what the Fed chair says and what ultimately is going to happen, who knows? I think the good thing here is that we know that the Fed presidents, the other members of the board, and the other members of the Federal Reserve, at least they have the ability to say what they think, and they're independent.
Always amazes me how much of the economy turns on a press conference quote.
Certainly, the markets are going to react.
Yeah.
Right. Even if the overall economy doesn't react, the markets are certainly going to react. So bottom line here is that this is something that you want to be taking a serious look at, especially if you're at or near retirement, how you're going to handle your overall debt. And it looks like it is becoming a bigger problem. It's one that you probably should be taking a look at. So we're going to take a quick break here. When we come back, I want to talk to you about naming life insurance beneficiaries and the 5 most common mistakes to avoid. And no, Lou, one of them was
ex-wife is not one of them.
Ex-wife was not. I don't think it was anyway.
Totally surprised.
So stay tuned. We'll be right back.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Well, welcome back. Hey, we're going to talk about naming beneficiaries on your life insurance, and actually have a graphic up. And I tell my clients there's three ways that your estate transfers to your heirs. It's real simple to remember. It transfers by law, by contract, or by probate.
By probate.
Yeah. By will, by your will, basically. Okay. By a will.
Yes.
If you don't have a will, the state will appoint one for you.
By law, which outlines how things go, or by contract, which is an agreement you enter into, or by probate, by your will.
Correct.
Yeah.
Yeah, exactly. So what we're talking about here is by contract, and different. There's different types of accounts that have beneficiary arrangements. Now, one of the advantages of naming a beneficiary is that it goes outside of your probate estate. Right.
You avoid probate.
Right. And
Always a good thing.
Right. And so types of contracts, types of transfers by contract would be your retirement accounts. Your retirement accounts have a beneficiary, right? Your investment brokerage accounts or your bank accounts can have a beneficiary. Now, this is an area where a lot of people don't know that they can do this, and it's overlooked in a lot of cases. But in my business, we call it a TOD, transfer on death. In the banking business, I think they call that POD, paid on death. Those are the acronyms that I've been familiar with. And so those are for your non-retirement accounts. You can actually name a beneficiary. What's the advantage? It passes outside of your probate estate. And of course, life insurance and annuities, you can name or should name a beneficiary. But a lot of people make a lot of mistakes when they're naming a beneficiary. And this is something that you should keep in mind, especially if you have some employer-provided some group insurance through your employer, because a lot of times, if you're buying an individual contract, life insurance and annuity, typically the agent is going to ask you to name a beneficiary. Whereas when you sign up for group life insurance, a lot of times they don't.
Really?
They do, but
what's the point of having an insurance policy if you don't have a beneficiary?
Well, that's one of the mistakes.
Yeah.
That's one of the mistakes, Lou. So, first mistake is not naming a beneficiary.
It's like kind of side roads the whole process, doesn't it? I mean, it's the whole point of the insurance policy. The whole point of insurance, yes,
is to have
life
a beneficiary,
insurance is
right?
To have a beneficiary,
right? Exactly. And as I said before, the agent, when you're buying a life insurance policy, typically will have you name a beneficiary. But in some cases, like in a group insurance plan, you don't have to, and you're signing up through your annual review of your benefits, and you're signing at the time you start your employment.
Yep.
And there's a amount of paperwork you have to fill out and sign.
You don't have an ex-wife yet
to worry about.
Yeah.
And so you neglect to put a beneficiary on that life insurance policy.
So what happens? Probate?
So it depends.
Yeah.
These are contracts, right?
Yep.
So it depends on what the institution that's insuring your life will do. And so it's all laid out in the contract. It says, if we don't have a beneficiary, here's what we're going to, typically they'll pay it to your estate. And so
Probate.
one of the benefits of having a beneficiary is it avoids probate, right?
Yeah.
Not naming a beneficiary, you just lost that.
Yeah.
You just lost that benefit because now it's going back into your estate. You don't want that to happen.
No.
Right. Yeah. A lot of people will actually name their estate
Really?
as beneficiary. This is something that you probably would rather not do if you don't have to.
Again, I don't get the point, but yeah.
I've seen it happen a lot of times. Yeah. In some cases, you don't care about avoiding probate.
Yep.
The problem is that by naming your estate as a beneficiary, it ties it up in the probate process. So first of all, you've got the delay because now you've got to go through the courts. I haven't talked to an attorney about what happened during the pandemic. I mean, I've heard a lot of stories
Can you imagine? Yeah.
about divorce court and how that was all messed up. But I can imagine the whole probate process was delayed as well.
Yeah.
Right. And so you have your normal delays. So the money gets tied up. This is money that you intended to pay to your heirs so that they'd have the money potentially immediately, and now it's tied up in the probate process. Plus, there's the costs that are associated with that, and a lot of times those costs are based on the value of your estate. So you just increase the value of your estate, potentially increase the cost, but you also made that money available to your creditors.
Yeah,
because your creditors have an opportunity to file suit to collect the debt against your estate, and so you just made
another
your
great reason to have a beneficiary.
You just named your life insurance policy, or you just put your life insurance policy in the hands of your creditors. How nice! You actually made your creditors the beneficiaries of your life
Just
insurance.
made your credit card
think about
company
that,
your
right? Yeah,
beneficiaries,
just make
yeah.
it right. Exactly, make your credit card company the
Yeah.
beneficiary. You probably wouldn't do that, right? But you did if you name your estate as the beneficiary. Naming a minor child as a beneficiary. Why is this a problem?
Because of the way. No, why is this a problem?
Because a minor can't own title to property,
Oh,
right?
so we're back to probate.
Potentially
Yeah.
back to probate. Somebody has to claim those benefits on behalf of the minor,
Wow.
and that can't be arbitrary, and typically is going to involve the probate court in order to get that money out.
That would be his son's ex-wife.
Yes.
Yeah.
That's definitely
Grandchild's
possible, right?
ex-wife. Yeah.
Right. So if you want,
interesting. So a child cannot own property. So that will void that child as a beneficiary.
no.
No?
You name that person as beneficiary. Once you die, that's it. It's irrevocable.
Mhm.
That minor is entitled to receive the value of the life insurance. You just have to figure out a way to do it.
Oh, I see.
And again, who's representing the minor and who's representing the interests of the minor? And the life insurance company is not paying it over to mom or dad just because they're mom and dad. They need a compelling reason, court order, generally speaking.
Really?
Oh yeah. Yeah. They're not turning over that money to just anybody. They have to know that money is being, because they have a contract. They have a contract with the deceased.
Yep.
To make sure that money goes to a particular individual.
Boy, that could get messy, couldn't it?
Oh yes.
Yeah.
Yes, for sure. So, if you want the life insurance proceeds to be paid for the benefit of minor, you might want to consider creating a trust that names the minor as the beneficiary. So you create a trust.
Mhm.
The minor in this case is the beneficiary of the trust, but then you name the trust as your beneficiary of your life insurance policy. So the money goes directly to the trust, and the trustee,
Who's
whoever
the executor
name.
of the trust?
It's a trust, right? Exactly.
Okay,
So
yeah.
the person that's responsible, the trustee, would actually make the claim and receive the proceeds for the benefit of the minor child. So that would eliminate that problem and the delay and the possibility that, as you said, it could get very messy, right?
Yeah.
But that does require a that you set up a trust, and it requires that you get legal advice. And
Yeah. Just don't do this on a website or at your kitchen table.
well,
Yeah.
that definitely is one option, right?
No, just not a realistic option, but yeah.
Disqualifying a beneficiary from government assistance
Oh my.
is another potential problem, right?
Yeah.
So let's say that you have a disabled child, for example, that would be eligible for some benefits, either Social Security benefits or state Medicaid benefits,
Mhm.
right? And you name that individual as the beneficiary of your life insurance proceeds. Well, all of a sudden,
Many of those benefits are means tested.
and based on assets and income, and in this case, it would be a significant,
Yeah.
potentially significant increase in the assets, and would potentially disqualify that individual from getting those government benefits, and making them rely on the life insurance proceeds
Yeah.
until they're exhausted.
Yeah.
And they would be able to again apply for benefits because they no longer have the assets, right?
Yeah.
Um,
You could see how that mistake gets made. That's thinking 2 or 3 steps ahead.
well, if there is any possibility, and this would be something that any family, any parents that have a disabled potentially a disabled child would probably already be thinking about,
Yeah.
but not knowing exactly what to do.
Right.
By the way, a trust is a way to just like for a minor, a trust could be a conduit for those funds. A properly drafted trust that doesn't give the beneficiary direct access to the principal could preserve the value of those benefits, still give that the trustee the ability to provide support for that disabled individual, and still and prevent the government from disqualifying them for benefits because they don't actually have control or can't themselves access those benefits.
And it suddenly occurred to me, what about financial aid, things like that? Your beneficiary could really affect financial aid for a child or a grandchild.
Yes, that's a great point.
Yeah.
Yep, absolutely.
Same
Yeah.
type of situation.
Same type of situation.
Yeah.
Yeah. Yeah. And again, the trust could
I mean, God knows where we are 5 years from now, but right now that's a significant amount of money.
correct.
To deal with.
That's a great
Yeah.
point. Yeah. Yeah. And so a trust, actually, a properly drafted trust could solve that problem as well.
Hmm.
Yeah. And let's see, what do we got? We got 4, right? I think I said there was 5 mistakes
Let's
to
see if
avoid.
there's a 5th.
Let's see if there's a
Let's roll a dice. See if there's a 5th. Yeah.
Yeah. So one of the mistakes a lot of people make on a regular basis is that they don't review those beneficiary arrangements.
Right.
So this probably gets to your ex-spouse, right?
Yeah.
So you were married, you had your spouse as a beneficiary, understandably, and now you're no longer married, and you forgot to check the group insurance policy. I've
Oh.
seen that happen a lot.
Yeah.
And you die, and as I said before, that's an irrevocable
Yeah.
circumstance. Whoever the beneficiary was on the day you died that's the person that the insurance company is going to pay.
But you have a grandchild as a beneficiary, for example, and your son's wife has full custody or has custody of the child, and you want your son to have control over those benefits or administering them, as opposed to the ex-wife.
Right.
Yeah.
Yeah. Exactly. Yeah. Definitely.
Or both are named as a beneficiary to take care of the grandchild, and they're no longer married. That's not a situation you want to get into either.
Right.
Yeah.
Yeah. Yeah. And so so one of those one of the mistakes I see people make a lot is that they name those beneficiaries, they don't review them on a regular basis, and circumstances change. Beneficiaries pass away, and they have to be
true.
right. And so, what happens if one of the primary beneficiaries, is not alive when you die? Well, the next beneficiary typically is going to take that person's place. But if you didn't have a secondary or tertiary beneficiary, then the insurance company is going to be looking for the descendants potentially of that beneficiary. And again, that might not be what you what you intended, right? So
I was thinking about a guy passes on, and wife number 2 thinks she's getting a life insurance payout, and the beneficiary is still wife number 1.
Right?
Yeah. Just never get around to changing it.
Right.
Yeah.
Yeah. It happens.
I'll bet.
I've seen it happen.
Yeah.
Yeah. You just reminded me of another circumstance. Actually, this really has to do with divorce, and something that I think if you are in a situation where the court has mandated that your spouse carry life insurance, it's usually part of any final divorce settlement is life insurance to protect the ex-spouse, especially if there's some sort of a support order in place. If you die, to guarantee that there will be money there to meet your obligation. And the problem with that is, in many cases, the spouse will apply for the insurance. The spouse that's mandated to buy the life insurance will apply for the insurance, become the owner of the contract, and be responsible for making the premium payments. And as long as they maintain their ownership and control of the life insurance policy, then they can change the beneficiary. So,
and the court order doesn't override the beneficiary change.
Well, no. The court order says you have to have this policy. It has to be in this amount, and your ex-spouse has to be the beneficiary. But what's to prevent them after the policy is issued? After you've been divorced for several years, what's to prevent them from changing the beneficiary? Now, they're violating a court order. They could be found in contempt. There's no question about it. But who's going to know?
Post-mortem contempt?
Nobody. Well, So, well, that again, what the insurance company, it's a contract between the insurance company, and so the insurance company isn't being guided by the court order. The insurance company is being guided by the individual who bought the policy, bought it for a specific reason, named his ex-spouse as a beneficiary. Understandable, but as long as that person maintains the ownership and control, can change the beneficiary. And you find out because you're not constantly checking on that. The insurance company had no obligation to you to let you know that the beneficiary was changed. So really what I advise my clients in those circumstances is that you want to be, if you're the beneficiary, and the court has mandated that your ex carry a life insurance policy with you as beneficiary, you want to be the owner of that policy. Or you want to be an irrevocable, here's another way to do it, irrevocable beneficiary.
Oh, I didn't know that.
You can do that. Right. So what that means, if it's done properly, is that the beneficiary has the right to stop any changes to the policy. The owner insured can't change the beneficiary, can't cash in the policy, can't change the owner of the policy without you without your consent.
I think you just answered a question I didn't know I had, though. But so you can take out a life insurance policy on someone else and name yourself as a beneficiary. You can own a life insurance policy on another individual
and name yourself as a beneficiary. Yes. If at the time that you apply for the insurance policy, you have what's known as an insurable interest.
Oh.
You have to have an insurable interest. You can't just buy a life insurance. I can't buy a life insurance on Lou.
Can't do
although I think I could demonstrate.
You probably
my
could.
dependency
Yeah.
on you at least
Yeah.
once a week.
Yeah. It'd be like
I'm not sure what the life insurance policy would be worth, but
it'd be like running a death pool.
it'd be like running a death pool, right?
Yeah.
So you have to have an insurable interest. So spouses is an example, or
So I can't say Harry's not
business
looking
partners.
good. I'm opening up an insurance
You
policy.
cannot.
Yeah.
However, there is a whole business of third parties buying existing life insurance policies. Harry's
What?
not looking so good. Does he have any life insurance?
What?
Yes.
Third parties buying life
Third
insurance?
parties buying life insurance policies and becoming the owner and the beneficiary of that policy.
So
So
that
Lubla-
the
Lubla's
individual gets the money up front,
It's
pre-death.
a discounted
Sure.
value.
I imagine heavily discounted.
Well, it depends on your longevity.
Yeah.
Okay. Depends on your your medical diagnosis.
Yeah.
If the doctor says that you're only, the doctor advises you not to buy any green bananas, then
Okay.
then you might get a pretty large chunk of that money.
Good percentage of it.
Yeah. But if you're in pretty good health and you try to sell that policy, that
So is there a website? Is there where is this market for?
they're advertised on television all day long.
So companies are doing this.
The companies are doing. Oh yeah.
Yeah. Okay.
Oh yeah.
Yeah.
Yeah. Yeah. And you know what? When this became a more mainstream, I guess, type business was during the HIV.
Really?
Yeah, because there were a lot of people who were dying of AIDS could use some money that had life insurance,
Yeah.
and they couldn't access the death benefits.
Yep.
And so with that money, they might have been able to buy treatments that they wouldn't ordinarily receive. So life insurance companies started to accelerate death benefits, but at the same time, other third party financial institutions were out there soliciting the purchase of those policies to give you a lump sum.
This is why I love capitalism.
Yeah. It's
Because think of the benefits for people in that instance.
yeah. Well, it's sort of morbid because
It's-
the investor in this particular case is better off if you die sooner rather than later.
Yes.
So keep that in mind.
But again, you're getting the accelerated. You're getting the death.
Yeah,
benefit
no,
to use
it's
for
no,
yourself
yeah,
and-
no, it could be
Yeah.
potentially a win-win. No question about it. Yeah. So we're gonna take a quick break. When we come back, I've got this week's Talk Money tip, and it actually coincidentally is about naming a minor child as beneficiary, which we said was a mistake,
Yes.
but there might be a way to do that and do it in a efficient manner. So please stay tuned. When we come back, we'll have this week's Talk Money tip.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back. Hey, before I forget, if you want to reach me after the show, just dial the toll-free number, 877-475-2062. You can send me an email, jeff@talkmoneyradio.com. or you can just send us a message right on the Facebook page. We're glad to hear from you. Reminder, we do offer a initial no obligation consultation. We'll take a look at your situation. Tell us what's bugging you. If you have some areas of particular concern, we can address those. And bottom line is, it's an opportunity for us to find out whether or not it's a good fit, whether or not it would make sense for us to work together. And we do try to justify the fees that we charge through savings and taxes and other areas. We really want to add value to your situation. So we want you to be able to work with us without it really without there being a net cost to
For
you.
example, based on today's show, they could talk to you about a reverse mortgage. They could talk to you about naming beneficiaries. They could talk to you about estate planning, right? Three of the things we talked about extensively today.
Yes, absolutely.
Yeah.
So this week's Talk Money tip, Lou, is as I mentioned earlier, one of the mistakes that people commonly make when naming life insurance beneficiaries is they name a minor as the beneficiary. And as we said, minors can't hold title to property, so somebody would have to be appointed, essentially, typically by a judge, to be the person who would represent that minor and make claim on a life insurance policy. And of course, that's all beyond your control because you're gone.
Could you
Right.
could you name that aspect of it as part of your will on top of the
Absolutely,
Right.
but then then you're making the estate, the beneficiary of life insurance policy, as we discussed. You're delaying the process. You're increasing the cost of settling your estate. So having a trust is a good way to avoid that. So you set up a trust, you hire an attorney, you pay them a fee, you set up a trust, and you name the trust as the beneficiary. Typically, what's going to happen in that particular case, if you haven't done any other estate planning or transferred other assets to it, is that policy, that trust pretty much sits there dormant until such times as the life insurance proceeds are paid. It's an expense. I'm not saying it's not the right way to do it, but it's an expense, and takes some time, and you have to do it right, and you have to keep on top of it on a regular basis. But there is an alternative. It doesn't take the place of a trust, but what a lot of people don't realize is that you have flexibility in the language of your beneficiary arrangement. And you can, if you name a minor beneficiary if you name a minor as your beneficiary, whether it be a primary or a secondary beneficiary, you can, in the language of the beneficiary arrangement, name what I term as an informal trustee.
Okay.
And so you tell the insurance company up front, I want this money to be paid to my son, regardless of his age, right?
Yep.
And if he's a minor, then you can pick an age. It doesn't have to be age
Interesting.
21. You can pick an age, right? You say if my beneficiary is below a certain age, I want this money to be paid to this other individual as an informal trustee. At that point, the insurance company has no choice but to pay it to that individual if that individual presents a claim on behalf of the minor beneficiary. Now, the problem with that is, and an attorney who works with trusts would tell you, there's no guarantee under those circumstances that person is going to do the right thing with that money.
That person has no legal obligation to do anything with that money.
Correct. Yeah. They've made a claim, and
literally a trustee.
They really have a duty, I think, at that point, if they've made a claim, to make sure that. And I would imagine that the minor beneficiary at some point could have a civil claim against that person if the money wasn't used properly. But it is a real simple, low cost, no cost way to. And if you name that individual, that you name in the trust, the adult, as your informal trustee.
Yep.
If you trust them, then really not a problem.
Mm-hmm.
And what they should do at that point is they should really set up the accounts, maybe establish a trust on for the benefit of that individual, or just set up some accounts naming them as beneficiary or something along those lines. But they have a lot of flexibility, and it doesn't cost you anything, and you didn't have to hire an attorney to do it, and it does solve the problem, at least temporarily, until maybe you have a more comprehensive estate plan put in place.
So it's a nice informal way to deal with this, but with the caveat that the person that you're naming as the trustee of the beneficiary has no legal obligation to do the right thing with it.
Right.
Yeah.
Right. There's risks in just about everything you do, but this is a way to at least keep the courts out of the process. And also, let's say it was you have an ex-spouse, and you didn't want the ex-spouse to be swooping in and getting that money on behalf of your.
Oh, wait a second! I got a question for you.
Yeah.
Does say the father, the son of the person named, he's the trustee for the grandchild.
Yeah.
Has an ex-wife. Is all of that susceptible while the child's a minor to
I'm not sure.
divorce
I'm
settlements?
not sure the circumstances there, but let me give you a scenario, right? Yeah. So you're divorced, right? And you have only one child, and you name your child as the beneficiary. Minor. Yep. And you do nothing else. Well, what's going to happen to that money when you die? It can't be paid to the minor. Who's going to come along and present themselves to the judge and say, "Hey, judge, I'm going to claim I can take care of this. Just tell the insurance company to pay me the money."
Yeah.
Right. You probably wouldn't want that to happen. So what you do is, in that beneficiary arrangement, you name your parents as the informal trustee. They make the claim against the life insurance policy, and now the ex-spouse really has no legal standing to make a claim on that policy, and has no access to those funds.
Now, my question was,
yes,
you have a grandchild.
Sorry. Yes.
But via your son.
Okay. Oh, I see.
And you name the grandchild as the beneficiary, and you name your son as the quote-unquote trustee.
Yeah, that's probably not a good situation.
Until a certain idea, and the marriage falls apart, are those funds part of the divorce settlement?
Depends on what the ex-spouse did with them in the meantime.
Yeah.
So if they did the right thing and they set up a trust, then no.
Right.
If they didn't do the right thing and just put money in an account with their name on it without the minor's name on it, then that's a problem.
That's a problem.
Yeah, that could be a problem.
Yep.
Yeah. So it depends on what you do with the money once you get it. If you've been named as the informal trustee.
So much going on.
Yeah.
That's why you need an advisor.
Yeah. Hey, I mean, this is something you should be doing on routinely.
And these are things that someone would never. A lot of these things are something no one would ever think of.
You wouldn't. Yeah.
Yeah.
Until it was too late.
Right.
Right. Yeah. All right. So hey, that was great. Thanks for tuning in today. We'll be back next week here on Talk Money, same time on Monday morning. And by the way, you can see all of the prior shows, some good stuff there, everything from life insurance to college financial aid. And they're all there in the archives. So feel free to
credit report
browse
repair.
through.
There's a couple shows in there on that.
Yeah.
Yep.
Some real good stuff.
Mm-hmm.
We are accumulating quite the library. But we'll be back next week, same time here on Talk Money. Remember, in the meantime, good sound advice is much better than advice that just sounds good. Thanks, Lou.
Okay. Money.